Hello, everyone. From Chicago, I'm Charles Brown, Portfolio Manager with CB3 Financial. Welcome to another episode of CB3 Live. This is a very special episode. So I would say maybe 2/3 of the way through my career, too late for me, I discovered the relative rotation graphs, better known as RRGs, designed by Julius de Campinar. And incredibly, I've been able to get an audience today with Julius, and we're going to talk about some topics on RRGs as well as some other sector topics, because sectors are really what Julius is all about, and the RRGs are a subset of that. So buckle in, grab some popcorn, whatever you want to do. Ladies and gentlemen, this is CB3 Live, and this is Julius de Campinar from Amsterdam. How are you, Julius?
I'm fine, Charles. Friday evening here, so no better thing to do than talk to you.
Absolutely. That's great. So there are hundreds of interviews with you out there and videos and instructionals. Because of that, I want to dig a little bit deeper and maybe appeal to either those managing a family office like I do, portfolio managers like myself, to just explore RRGs to a little deeper level and then look at some more of your sector analysis. So amongst literally hundreds of indicators that traders and portfolio managers, aka PMs, use to trade and manage accounts, RRGs, in my opinion, stand alone in their visual interpretation of the market. So when talking to PMs unfamiliar with RRGs, what's the most compelling reason for them to invest the time to learn RRGs? I have my own reasons. I'd love to hear yours.
Yeah, I think that, it was designed while I was working on the sell side as a professional analyst for an investment bank. And my clients were PMs at large investment firms, Fidelity, BlackRock, large asset managers. And the big difference between what they do and what a retail trader or a retail investor does is they are all about relative performance. And it's the game where, hey, the market went down 10%, but I only went down 5%. So I'm a king because I outperformed the market by 5%. Sorry, I still lost 5% of your money, but I'm really good because I beat the market by 5%. That was the game that those people were my users.
And it's still the game
One of
in
it's still the
investment.
game
Yeah.
for a lot of people it is, for a lot of professionals it is. And their biggest problem probably is that they can't go cash. Even if they have, 2024 side, they know 100% sure market's going to go down. We're going to go in a bear market. We're going to lose 20% in the next 3 months. Like ironclad guarantee, they still cannot sell all their holdings and go to 100% cash because the people who allocated the money to their fund did that with a reason. They wanted to have that exposure to whatever your fund is, whether
And
that's
they pretty much
an S&P
expect
500.
constant exposure.
They do, yeah, because if you take a step back and you look at how that world works, you have strategists and asset allocators who decide we're going to have 50% in stocks, 30% in government bonds, 10% in corporate bonds, 5% in high yield, another 5% in commodities. So they do the asset allocation layer. Now, that 50% that goes into stocks maybe goes into an S&P 500 fund when it's a US company, or they divide it into sectors. And then each of these buckets have a portfolio manager. So if you're the portfolio manager of a technology fund and the asset allocator allocates money to that fund, that asset allocator may even be underweighting the technology sector. The asset allocator thinks, hey, I don't like technology right now. I want to be really defensive, so I'm allocating to utilities and staples and whatever. But technology is a really big sector. I still need to have some sort of exposure to technology, so I'm going to put 5% in that fund, which is about a 20% underweight, which is unheard of for a professional, by the way.
Right, because
But
technology is the largest sector.
yeah, just as an example. So, but he still needs to have some sort of an exposure. So that guy expects that PM to have 100% exposure to the technology sector. And he expects that PM to outperform that technology sector. If that guy goes to cash, that technology PM goes to cash, he is screwing up the asset allocation strategy at a higher level. Because all of a sudden, that asset allocation strategy does not have 5% allocated to tech anymore. It has 0% allocated to tech, which throws all the risk metrics off, and it becomes mayhem. So these professionals, they can't run away, they can't hide. So the only thing they can do is try to outperform that whatever their benchmark is. If we stick with technology, which is a nice example, they need to beat probably XLK or whatever, maybe the Nasdaq 100, something like that. And
That's a big ask.
it is a big ask, but so people, that's how that business works. That's how they roll. So my job was to actually cater for that clientele, and being a technician coming from the quant technical side, my universe was way bigger than of my fundamental counterparts. If you're a fundamental analyst, I don't know how many stocks did I cover, 15, 20, whatever. I mean, that's probably it. If you're a fundamental analyst and you cover 20 stocks, you're a pretty busy guy. Yeah. So technicians, we can cover a lot more. So at that time, I was covering the Stoxx 600, which is kind of the benchmark index in Europe. 600 stocks, 18 sectors at the time. That was my universe, and that is how I started doing that. And what I found out is that all these professionals are sometimes very focused, maybe over focused on a specific thing, because they can't pay attention to everything. So they need to to hop from sector to sector or from team to team or whatever. And I always tell this story where when you're on the sell side, even as an analyst, you call these people to pitch your story, because in the end of the day, the bank would only make money when the client would trade with us. It's not a subscription service. We only we take commission on a trade. So when I was talking to these guys, and I had 600 stocks, 18 sectors, so I usually would prepare 3-4 sectors, 3-4-5 stocks in each sector. I was like, all right, this is what I feel, this is what I think. And I noticed that when I would call these guys, they were all, I for some reason, I always prepared the sectors and the stocks that they were not interested in at the time. I don't know. It's like, you come from oh, no, Julius, don't, I'm not interested in chemicals. This week is technology week. I've got, I'm going to a conference with Goldman Sachs, and Morgan Stanley is having their analysts come in, and, whatever. So what are your best 5 stocks in technology? And obviously I hadn't prepared the technology sector at the time. So I was like, yeah, whatever, no story there. So I needed to figure out a way to sort of get that whole thing, get a broader picture, get it in front of them in one way. And obviously it didn't happen overnight. It was it's a process that goes over time. And one of the questions that they always asked me was, what are your best 5 stocks, or what are your best 5 sectors? And I couldn't really answer that, because in technical analysis, we either look at a chart, which tells you something about that particular thing. But if you look at 5 sectors and you look at 5 charts, you still don't know which of the 5 is the best and the worst. It doesn't tell you that. It just tells you goes up or down, or goes sideways. So what I then started using is relative strength, where we compare 2 securities. And then you could say, hey, this one is better than the other one. But even if you take 5 or whatever, you would have to make a lot of comparisons to get the entire picture.
And it takes time. That's
it takes issue. It takes a lot of time. But also, even if you have 10, your universe is 10, let's say 10 sectors. You would have to make, because if you compare them to the benchmark, the only thing that comes out is whether they are doing better or worse than the benchmark. but there may be 3 or 4 that come out that are doing better than the benchmark. So which out of this 3, 4, 5 is better than the others? Then you would have to start making those comparisons. So it's a big matrix with a lot of thing going on. So on a 10 by 10 matrix, you got 10 times 10 is 100 possible combinations. Now, obviously, banking sector, you don't have to compare that to the banking sector because that's the same. So you can subtract the number of elements in the universe. So 100 minus 10 leaves us with 90. If I have looked at banks versus technology, I've already seen technology versus banks because it's the reverse.
Exactly.
So
the reciprocal is
yeah,
self-explanatory.
exactly. So that 90 I can divide by 2, but it still leaves me with 45 possible combinations. Now, if you need to flip through 45 charts, 45 individual comparisons, it's probably doable, but in your mind it's difficult because you look at it like, oh, here I have technology beating banks. That's nice. And then on number 15 it's like, hey, technology is also beating staples. And so it becomes blurry.
And overwhelming. I had invented a new word, and I don't know if you want to use this or not. I don't think it's a word. What I most like about RRGs, and I attribute this word to, and I see if I can pronounce it right, the instantaneousness of the tool is what is most valuable to me. I put something together in my basic buy sell engine, and we're going to get to that later in here as far as using it as a primary tool or secondary tool. I do have a primary tool, and I've got my reasons for that. But when I want to check my research, the instantaneousness of RRGs is absolutely worth everything, and there is no other tool that can do it.
Yeah. So I realized I was giving you a very long answer to a very short question, which I could have answered very rapidly. So it popped in my mind when you said instantaneous. I come from a military background. And one of the things that is very important in the military is what is called situational awareness. What's going on around you? And that is what RRG provides a PM. It provides you with situational awareness. It tells you what's going on. Instead of looking at one chart or whether that's the S&P or a sector or an individual stock, an RRG tells you what's going on around you, and it can do that at various levels. You can look at an RRG of individual stocks versus a sector index. That's a very low level. You can look at sectors versus the S&P 500. That's a level higher. But you can also look at what we just said with asset allocation, at stocks, bonds, government bonds, commodities against some sort of, I always use VBINX for that. I like that. It's a Vanguard balanced index fund, which is a 60-40, which is kind of sort of representative, I guess, for a lot of RIAs running client money. Like, so what is your benchmark? I want to beat, the balanced portfolio, which is a 60-40, 60% stocks, 40% bond portfolio. And the situational awareness that an RRG gives you, I think is unique.
Yeah, there's no question. So I just finished listening to the 185th episode of Sector Spotlight. I think I've heard them all. There is much more covered than just RRGs in your educational offerings. And I want to be sure we dig into that in this interview because most people just think, okay, Julius, yeah, RRGs, yeah. No, it's way more than that. So what is the comprehensive goal for Sector Spotlight and how has the show evolved since episode 1? And I remember episode 1.
Yeah, I should look that back. It's probably very funny when you look back at number 1 with all these.
You used to wear a bow tie, right? Like Tom Keene on Bloomberg. I'm just kidding.
Would I? Yeah, I should have. Would have made me stand out. Well, I mean, it's definitely learning on the job, 100%. It's evolving. Tried a few things, ditched a few things. Try to bring it to. I try to keep a few segments coming back. So at the end of each month, so the last, I used to do it on Tuesdays, but now Stock Charts has gone all YouTube, so we can pretty much produce and publish whenever we like. So I opted to do it on the Mondays, like at the start of the week. And I would always record it on Monday evening, and then it was going to be published on Tuesdays, like midday, like 11. So right now I am recording it, trying to record it on Monday during my daytime. So that's before the U.S. market opens, or when the U.S. market is just opened. And then have it uploaded on Monday evening instead of Tuesday. So we
The
gain a
nice
day
thing for
there.
us is the weekly bars are closed at that point, and we can
Exactly.
get,
Yeah, we
yeah.
don't have that little flimmer, which I used to have on the other one. So that's a benefit. And at the end of the month, so the last Tuesday, which is now probably going to be the last week for the month, I would do a segment or show which is looking at seasonality. So what I do there is I look at the seasonal patterns for sectors, which is a 100% theoretical thing. Of course, you just go back, in my case, 20 years, figure out which sectors have been doing very well during that period of the year, have been outperforming the S&P 500. That's the theory, and then I try to overlay the current rotation on the RRG and see if there is a match. So if the rotational pattern for a specific sector is suggesting strength for the coming weeks, and I see that that sector is on a positive trajectory on the current RRG, then I have two things confirming. So it gives me a little bit more,
Corroborating, yeah.
yeah, a little bit more confirmation that the odds for that sector to move in that direction. And it can be good and it can be bad. A lot of people look at seasonality and they only look for, like, oh, this went up like 70% of the time. This sector went up this month. But I also look at the other side. So if I see that a sector only went up 15% of the time over the last 20 years, or outperformed the S&P 15%, that means that it underperformed the S&P 85% of the time. That's
Yeah,
a
it sounds
very
like a short to me.
that's a very significant number. So when I see that sector, rotating through weakening or into lagging, I'm like, hey, this is confirming each other. This is aligning. So I'm trying to do that, trying to make a call on the seasonality and how that aligns with the current situation. And the one that you're aiming at is, I'm doing that I do it once a quarter, because that sector rotation model is really long term. It evolves very, very slowly. Um, so I do that somewhere mid-quarter. I try to sort of, it's a little bit, depends a little bit on how the show goes and what happens. But once every quarter, I pick up that sector rotation model, and I try to, again, do the same thing. The sector rotation model is pure theory. That is how it should work. This is the economic cycle. If the economic cycle is in that phase, these sectors are doing really well. And then, by the way, a lot of people forget there's 4 macroeconomic indicators attached to that sector rotation model. They're pretty crucial for the alignment of, it's not just sectors, it also aligns with the economic situation, and there's 4 indicators that we need to look at.
Do you want to talk about those briefly or come back to those?
Let's go. Let's come back to that. But that's the segment that I do, because we're talking about how the show evolved and what we're doing. So this is so I've got that segment. I will talk about that later. That's one of your questions that you send me. So we'll dig into that a little bit more. At the start of each month, when the monthly bars have closed, I do an update on the monthly chart. So what does the really long-term image look like? And then, I have a number. I obviously I do from time to time an assessment of how the sectors are behaving and where we currently are. I'm not a big fan of doing that all the time, because sometimes just in a week nothing happens. And if there is one thing that I really hate, is talking about something that has nothing to mention. You can easily fill 15, 20, 30 minutes with
Yeah, but you don't want stale data.
hot air. So if I can avoid that, I'll try to do that. Which is, by the way, also one of the good things that Stock Charts has now gone all YouTube, because when we were streaming, we needed to fill 26 minutes. That was the you had a half-hour slot with an intro and an outro and some teasers in between.
But now you can have whatever
I
length
can
you
do
want.
I can do 20 minutes. I can do 45 minutes. Doesn't matter. So we try to wrap it around 30 minutes because that's obviously the kind of optimal viewing time frame for YouTube people, or there's a lot of techno stuff going on there. So I'm trying to squeeze in a number of things. Sometimes I look at a specific sector. I dive into industry groups. I look at growth value. I look at sizes like large cap, mid cap, small cap, a combination of large cap, mid cap, small cap with growth value. I look at high volatility, low beta. Um, Occasionally I look at cryptocurrencies. So there's a whole bunch of things that I can touch on and try to come a narrative. But there's always that red line, that subject that comes back every time. That's the sectors and how they're doing and what we think about the S&P 500. That's what we're trying to bring together in various different formats. Equal weights. Sometimes I do equal weight because
Yeah, and I know you've
when they
covered
see
that
it,
too.
when there's a
Yeah.
difference there. So there's many ways to look at that, and obviously always use RRGs as a starting point. But then that I'll also look at individual charts after the RRG.
Exactly. So I've talked to other PMs, and I myself in the beginning used 3 different strategies. I'm not using these now because, again, it became a secondary indicator, but it's actually more powerful for me as a secondary indicator or a confirming indicator. But I'll just throw these out in case no one else has actually put them on video. So the 3 strategies I used to use were buy when an asset enters the leading quadrant, sell when it enters the lagging quadrant, buy when an asset is 50% into the improving quadrant, of course, banking on that it's going to continue past the wall into leading, and sell when it enters, sell halfway into the weakening quadrant, assuming that asset's going to continue, which, of course, sometimes the most successful trades I've found, and I'm doing this on the camera, it hooks back up into leading. Those are the ones you just love. My favorite pattern. And then third, buy when an asset leaves lagging, okay, and sell when it leaves leading. Now, those are probably simplistic, but if you stick to those, I found that I had some success with it. I needed to use daily signals. Weekly were just too slow. I don't know. Do you have a favorite for either aggressive traders, less aggressive traders, and how do you assess the strategy?
All right, let's do that reverse. So these 3 strategies are definitely, a good approach. It's exactly what it's all about. It's how I started using it. When RRG was first born, I thought of when you find something, we all have that idea like, oh, this is it. I don't need anything else. When it goes into leading, you buy. When it goes into lagging, you sell. That's it. Done. It's not. So the 3 strategies that you're listing are probably going from very conservative and very trailing to very aggressive. So that is that is the way it goes. And I was surprised because you mentioned the most successful ones that are leading, weakening, and then go back to leading without hitting lagging, or on the other side, lagging, improving, going back to lagging without hitting leading. That would be my 4th strategy. If I have to make a list, I would have added that to the list.
Well, that hook back into lagging is what I call the nightmare stock.
Yeah. Well,
we have a show here called Shark Tank. Kevin O'Leary would say, if it hooks back into lagging, take it out behind the barn and shoot it.
I need Kevin to make an ETF on RRGs.
He's quite colorful. But those hooks, I tell you, that's just that. And there's nothing else out there. I mean, that's what I tell PMs. And if you're watching this and you're a PM and you don't know RRGs, look for the hook.
Yeah, that's a good way out.
Remember that. Look for the hook. And when I say the hook, I mean the good hook. And that's weakening back up into leading. And I wouldn't say mortgage the house and buy that stock, but it's when it crosses back into leading and it's already been there, there is way more bid pressure than there is.
You know what happens. You know what the situation behind such a hook is, that it's all based on relative. So the algorithm looks at relative strength, it combines all those relative strengths that are on that map and puts them in their individual positions, which allows you to compare them all together. Now, if you just imagine, so you can probably show a chart of a relative strength line that goes down and then starts to gradually move up. That's when a tail on the RRG moves from improving into leading. It picks up that turnaround in relative strength. Now, we both know that even relative strength lines, they're not straight lines. They go jiggly. They go like, blah, blah, blah. It's a trend. So you can apply like the technical rules, like what is a trend, higher highs, higher lows, lower highs, lower lows for a downtrend, to that relative strength line. Now, when you went through that bottom and you started to pick up, and the RRG lines have picked up that turnaround, that's when it moves from improving into leading. Now, after the first rally, we're now in a relative uptrend. You can see how that starts to roll over. That's when that tail for that security moves from leading into weakening. And if it's a real strong trend and it puts in a higher low and it starts to pick up momentum again, then you are into the second or the third or the fourth leg of an already rising trend. And that's what you see on that hook. You see it from leading going into weakening and then going back into leading. That's when it's making a new higher low on your relative strength line. So basically, instead of picking up the bottom, the turnaround, which is risky because you never know whether it's the real bottom, it could go down. You're now banking on a new rally within a trend that's already rising. And that's why they're so strong.
And this is why I don't like looking at charts when I can get, and I'm back to my word, instantaneousness of, I would elongate the tail, and instead of looking at 3 weeks, I would look at 12 weeks. And in just seconds, I can see that's what I needed to see, or no, that's going to fail. It just reduces my time.
And the tail length's going to help you because that's a measure of power.
Right. And of course, you got to be careful having too many on the screen with a tail, but when you just have a few things and you're wanting to raise your focus on a few, that the long tail helps. That's what I find. So we talked about this earlier. For a while, I used RRGs as a primary indicator, and I love them. I just found personality-wise, especially because position sizing is not addressed in this, trailing stop losses, all that kind of thing. As far as actually managing positions are not covered in the technology, that I needed to do something else. But it's a primary indicator or confirming indicator. I mean, I haven't really heard this discussed that much in your video, so I thought this would be an opportunity.
Yeah, so you're absolutely right. RRG is an analytical tool in our toolkit. Running a portfolio, and I've done it, is a completely different ballgame. So that's why in a professional environment, you have a portfolio manager, you have an analyst, and you have a trader. And all three are crucial in the success of the fund or whatever. So the analyst can come up with an idea and say, hey, this is really good. We need to have this. We need to have that. Doesn't tell you how much, or
Correct.
or when,
or
whatever. I mean, so that's where like money management comes in. So I
For sure.
And yeah, so
sizing.
money management position sizing is kind of the same, So
Subset.
so I've
Subset,
actually written an article in my blog on stock charts. So what was the title? It was like analytics, portfolio construction, and money management are different animals in the same zoo, something like that. I can give the title to you, and it addresses exactly this problem. That you can have an RRG or you can have any technical analyst tell you this is really good or this is really bad, but it's not going to help you put together a portfolio. Are you gonna bank the farm on it? Are you gonna put all your money in that one stock? I don't think so. But if you have $100,000 portfolio and you feel really strong about something, putting on a $2,000 position may not be enough. It wouldn't justify the strength of your analytical stuff. So that's where your money management, your position
Sure.
sizing comes in, and your risk management. You know, when are you going to get out? When am I going to admit to
Exactly.
myself that I'm wrong?
Regardless of what the RRG or any other
Absolutely.
indicator says, there has to be
Absolutely,
an
yeah.
exit
So
strategy always.
I've always viewed RRG as situational awareness. It was my tool as an
Yeah.
analyst to tell a professional PM, dude, look, this is what's going on. You should pay attention here. 'Cause this stuff is doing really well. This is rolling over. This is getting out of fashion. And hey, watch this because it seems to be emerging. That was the whole idea, and you get all of that in one picture. And over time,
Yeah.
it's a lot of people say, I think one of the most asked questions, what is the track record of an RRG? How do I know? So I always ask
Well,
people,
yeah,
what
you
is the
can't.
track record of a bar chart? It depends on how you look at it. Depends on how aggressive you want to be. What universe are you using? So it's in the end of the day, it's a visualization of a market. That's it.
Right. And even if you put something super obvious like a parabolic on the screen, well, it's wherever the dots are. That's exactly my performance.
Yeah,
Well, no, they're gaps. I had a stock on the Euronext overnight, gap down. I had a nice 3% stop, but it
exactly.
dropped
Yeah.
14%.
No.
Not what I want to see, but it does happen. So, do you find that PMs and private investors use RRGs more for stocks or for examining other asset classes and even assessing relative economic indicators? US CPI versus Euro CPI, uh, Asian bond rates
Um,
or the bond index versus.
yeah, so a few things about that. I think most people use it for sectors because that's the default and that's what it was designed for, and that's probably the most popular implementation.
And when you say sectors, so looking at the 11 US sectors, but then if you pick XLK, importing the actual
Yeah,
holdings in
that would be
XLK,
the
or at least the
yeah that would
top
be the secondary.
80%.
So when people really dig into it, they would start looking at individual stocks versus a sector or whatever index they use. So sector first and then individual stocks. The other way around, asset allocation, or as you mentioned, the economic indicators is more rare. Um, the asset allocation stuff, I think is very valuable and very doable because we do have the data and they're commonly available. They're usually also daily data points. If you go to CPI, if you go to economic indicators like CPI, PPI, money supply, and that kind of stuff, I think it becomes a little bit problematic because these are usually monthly data series or quarterly data series. So
Right.
an
And you have to
RRG, the
use monthly.
algorithm
Yeah.
needs at least 100 data points to just to get going, to pick up any trends, and that is very long term when you look at those economic indicators.
Well, of course, we have CPI data for 50 years, and without dropping a name, but needing to drop a name, Ray Dalio talks in, yeah, let's look back to the 1870s and what was happening. I'm
Yeah,
sure you read his stuff.
I mean, when when the
I
when
understand it's less usable, but still, you could use RRGs to
100%.
see
Yeah,
long
and especially
term.
now
Yeah,
because we can now do monthly data points, so we can use monthly data on monthly data series.
right.
So
Which
it
is
was it
huge. It
was
was
weekly and
only
daily,
weekly and
yeah,
daily
and
on
now it's
stock charts
monthly,
for a
but also
long
intraday.
time.
So that was an improvement. And yes, it will help. And I can add to that we do have implementations with other platforms where we can have a parameter called sensitivity. And sensitivity allows a user to speed up or slow down the rotations. Um, it's a slider that starts that the midpoint is 4. That's the default. If you put it to 5, 6, 7, you are slowing down the rotations, so you got way longer rotations. If you put it to 3, 2, 1, you're shortening the rotations and you get faster rotations. So when you want to do the really long-term stuff, I would use monthly data, but then probably put the sensitivity down to 3 or 2 to speed up the rotations. There's a lot.
Okay. Well, that's good. That's an advanced strategy for people to use that have
Yeah,
just thought
it's
of
not on
using
stock
it for
charts yet,
sectors.
but we will
So,
get there. So I'm very much involved with the development, and it's more a limitation of getting time from programmers
yeah,
to
exactly.
actually
Because they
implement it,
have their
rather.
own strategies
Yes.
that stock charts to do. I get,
Well, it's yeah. So there's only a limit to how many programmers there are and what they can do.
so
So
probably for 20 or 25, I forget the exact number of episodes, you talked about spread trades. You haven't talked about them in a while, but that's where, some stock moving into leading would be a long, some stock, pushing through to lagging might be a short. Obviously, how you position that size, that would be, equal dollars, et cetera. Again, beyond the scope of
yeah,
RRGs.
yeah.
But do you have PMs or other pros using it for that? And either individual stocks or sectors or even asset classes. I'm going to overweight equities because SPY is, stronger than TLT. And
Yeah, all of the above, I would say, because the spread trade would involve someone going long and short. If you do asset allocation or sector allocation, you could go overweight, underweight, essentially the same approach, of course. And you're right. I did those trades for a while, but the problem is that I couldn't follow up with them enough. There was just not. It becomes a real. If you want to do it right, it becomes a real job, and it needs real attention. And I just couldn't um, provide the attention that it needs. But it's a super strong tool to use to get pair trading ideas, and there are actually people who license RRG for research who are doing that.
oh, that's interesting to know. For their
Yeah,
own,
so
they white label it
no,
essentially on their proprietary
yeah,
models, or
also research partner. One of them in particular is in Brazil, one of the largest independent researchers in Brazil. Is a partner of RRG Research, and they have a specific product which is all about RRG pair trades. Obviously for the Brazilian stock market, but it's pretty successful with that. And I'm pretty sure we can do something like that for the U.S. market as well, because it's such a very visual aid to say, this is my group where I want to get my longs. This is my group where I want to look for my shorts, and then apply your whatever your toolkit is to fine tune that. So,
and as you said, manage the buys and sells and
oh
risk
yeah,
management. So I want to finish here with what was in episode 185, and if you want to deep down on this, folks, go back and watch, episode 185. But I grabbed some charts here. And these are stock charts. These are not RRG charts per se, correct? Or are these actually yours? The first one that I have here, the full recession, early
the
recovery, full.
yeah, that's actually no, that's not mine. It's the sector rotation model. And when you go on stock charts, by the way, it's free. That page is available for everybody. It's called perf charts, performance charts. And if you scroll down, you will see the sector rotation model. And sector rotation model was described, written down by Sam Stovall, which is a pretty well-known, not necessarily a technical analyst, but he was a strategist. Worked for S&P, Standard & Poor's, for a very long time, and has just moved to. And I am not sure what the name of the company is. I can say it a
But a
hundred times,
very
just not.
big, like if you say a bird's eye view, we're talking almost a satellite view, kind of like a Dalio, and this kind of
Yeah,
tool is really helpful for that. So
it looks
because I want to have a
looks
little bit of humor in our episode, so what I'm going to suggest for the next software version of this is, can you just add dates to it so we know
Oh
where we
yeah,
are?
yeah. That's in the pipeline. We are very close to adding those dates. So
I mean,
yeah,
think how much
maybe the
easier that would make our job.
yeah. I'm thinking about getting the time in there as well. You know, the time of the day. So
So, and if you could now correlate these with like the announcement of non-farm payroll and what that's going to have in the future. All right, for those of you watching, Julius
Yeah.
and I are just having fun now. This is obviously a tool. If we knew the exact time we were in these waves, it would be a whole different revelation. But still,
Yeah.
very useful. If you want to, I've got this is the second slide we've got on the screen now, where you can see the four, or I call them the three really aggressive sectors: technology, discretionary, communication services. But adding industrials in there, materials and energy, actually similar sectors, and then the conservative sectors or the risk off sectors clearly out of favor. And that's what I'm remembering from your episode, that it looks to you like we're getting ready to just launch here. And
Yeah, it's so from a sector perspective, you're right. If you what I did is I I look at, because this again, this is theory and RRG is what's actually happening. So what I'm doing is I'm looking at the RRG, looking at I'm making an assessment, and that's my assessment. Somebody else looking at an RRG can have a different assessment. That's all good, but it's my assessment, my take on how these sectors are currently rotating, and then color coding the sectors across the top of that sector rotation model, and see if they are aligning. And what's happening right now, the alignment's actually pretty strong. It usually doesn't happen like that. Usually the alignment's not that strong. So what happens here is that when you just look at the sectors that are currently doing well, they are aligning with a stock market going, in a bull market, being in a rally.
yeah, I would say the only piece missing for me, at least in my background, is the financials. You want to join the green there
I think the financials have already had a little positive run a couple of months ago,
because
because
of
this
interest
obviously,
rates, right? Yeah.
yeah, so they're already out of favor. So as you can see, the financials are at the end of the cycle. So they're at the very early recession, and then basically this graph goes on indefinitely, because when you at the end of the early recession, you pop right back into full recession. So financials are just before discretionary. Financial real estate are just before technology and discretionary. And so financials and to a degree, real estate already had a little bit of a run up, and they're now out of favor. So they're rotating now. They have been rotating. And by the way, basically during all of 2022, you saw staples, utilities, healthcare in the green, because these were the defensive
Well,
sectors when the
yeah, in
market
the
moved
huge
down.
pullback.
So
Yeah.
these so at that time we were getting out of that recovery, going down. We had that bear market, we bottomed out, and now you see that move going. And one of the things that I in Sector Spotlight do on a regular basis is break down the universe into offensive, defensive, and economically sensitive sectors, and then try to see if I can get a common denominator for each one of them. And what happened at the end of 2021 is that I saw a very clear rotation into defensives. Well, the market was still going up, so markets
Exactly, because the high was
was
January 4th, and yet you were seeing this prior to January 4th,
yeah,
2022.
so it was rotating out of tech, com, discretionary, etc., into defense, into staples, utilities, healthcare. And that rotation was so strong that it was able to keep the S&P going higher. But under the hood, it was very clearly visible on an RRG that the market was moving to a more defensive stance. Now, with the big sectors, tech, discretionary, financials, etc., if they're not going up, then that's not sustainable for the smaller sectors to hold up. So that's when it rolled over. And what you saw happening at the end of the bear market, so let's say end of 2022, start of 2023, you saw money rotating out of defense, not necessarily immediately back into offense, but very clearly out of defense. And that was, for me, it was like, hey, market is getting ready to move, because everybody's like, oh, we don't need that defense anymore. We're going to pull our ammunition out of defense. We're getting ready to actually move somewhere else. And that's what you're seeing right now. Now you see the sector rotation moving the money into technology, discretionary, etc. And it's very nicely aligning with the sector rotation model as it's in the theoretical chart. the one thing that you shouldn't forget is there are four macroeconomic indicators that are also part of that model. A lot of people only look at the sectors, and it kind of works, but when you bring in the economical sectors, you get a better handle on the economic phases. And these are and if you put the thing on the screen, you will see there consumer expectations, industrial production, interest rates, and the yield curve. Those four things, and the model describes exactly what you need to look for. So it has, for all of these four indicators, it has a certain type of behavior that should take place during a certain phase of the economic cycle. And what I do again is look at the actual chart and then see what is that doing, and then look into the table and say, hey, okay, so consumer expectations, when you look at that chart, it's clearly rising right now. It's pointing straight up.
And I've got the example of that, yeah.
Yeah, so it's going straight up. So very easy. That puts, according to consumer staples and that economic indicator, puts the market in early recovery. And I do that for all four of them. And then I see where the dominance is, because they're never always aligned nicely.
So the fourth one is yield curve, that you just mentioned. We both know the yield curve has been inverted for how long? Like 8 months. Yeah. It's incredible.
I know, and the degree of inversion it's almost 1%. So that's a thing. And so that also makes it a hard indicator to assess in relation to this model.
Do you think it has anything to do with the slowness of the recovery? Because when the S&P came 20% off of its October low, we officially entered a bull market in the S&P, obviously. The data that I've heard is that it's been 40 years since we've had that long. Not 2008, not 2009, not 2020.
The inversion.
The longest.
Oh,
yeah.
Way back. Yeah, absolutely. Let me see if I don't have that right here. I can bring it up,
but 100 basis points, what you're saying, I mean, to see it inverted 25 to 30 basis points is one thing. 100? It's crazy.
Yeah, well, first of all, inversions don't happen all that often. They're pretty rare. And this one is long and deep. The only thing, and I have some sort of an economic background, but I'm certainly not a specialist or an expert. What I'm trying to do is basically use common knowledge and try to align that with what's happening in the markets. But somebody pointed out to me that one of the big factors is inflation. And when you look at the yield curve and correct it for inflation, then it's still inverted, but with way less. And it's moving
So
up.
It's within the norm. It's not an outlier.
Yes, and it's called the real yield curve. I'm trying to figure out how I can bring that on a screen and without having to jump through 100 loops. But that kind of makes sense when you bring in inflation, because interest rates are high, but inflation is also high. So when you borrow right now at 7%, and inflation is, I'm not sure what the number is in the US, was probably like between 5 and whatever, maybe it has come down a little bit. But then your real yield is only like 2 or 3%. So that is a serious factor to take into account. And obviously that hasn't happened for the last 10, 15 years. Inflation was kind of non-existent. Interest rates were super low. Just use them together. That's all good.
And there it is. So I'm going to cover one last graph and we're going to let you go here. But I mentioned the word outlier. We're in an outlier situation. You've got a chart here, and we're going to put this on the screen right now, where XLE is an outlier. And in your episode 185, and I just want other PMs to know this, when you have a sector that is an outlier out there dancing by itself, it's more common, I think, to see this with a stock. Like a crazy stock like NVIDIA or something inside XLK.
Absolutely.
Or AI or one of those other, or a biomed that just, rose 50% in XLV. How is it that you treat this? If you're trying to do a sector analysis, do you just remove that? How do you deal with these outlier, whether they're outlier in lagging or leading or wherever they are?
Well, yeah, the obvious answer is it depends. But
Right. I know.
so
That's why
so
I'm asking you.
yeah, so obviously, one of the reasons I take them out is because they distort the image. When I bring up an RG on the screen, and you got like XLE, which is like way to the left inside weakening with a very long tail, because the software wants to show all of these tails and all of these charts, all the other stuff is pushed to the other corner, and it becomes sort of unreadable. So when I look at it, I think, all right, XLE is way on the right into weakening. I know that. I don't need to see that. I know now where it is. So I take it out of the equation. I blow up the chart. I get a better handle on the rotations of the other sectors, still knowing where XLE is moving.
Would you be more inclined to take that out if it were in leading or improving or lagging, or doesn't matter?
Doesn't matter.
Any of the
Doesn't
four
matter.
sectors?
Just for me, it's just a visualization. It's just a way to get a better handle, to better zoom in, and just still be aware where that Lone Ranger is moving. Because XLE right
I'm
now,
hoping that the go ahead.
yeah. So
Julius.
XLE is inside weakening, but it's got a very long tail. So the odds for this one to make that hook are actually pretty big, because it's a very strong trend. We went through a very strong relative trend, by the way, not a price trend, relative trend. We're in some sort of a correction right now, but we've seen numerous times where these tails that are moving make these big rotations. They come back up. This is not a one day
With
wonder.
velocity, this is like a what do they call it? Cat 5 hurricane.
Yeah.
What it does, you need to pay attention to more than a Cat 1 hurricane.
Yeah.
So for the PMs that are watching, guys, I hope you've gotten a lot out of this. Julius loves to hear from people. I know that. He's answered my questions over the years, been very appreciative of that. Just give us a summary of where people can find you, where your blogs are, if they want to subscribe to seeing you on stock charts or anywhere else. This is your chance.
Yeah,
It's
so
promo,
I mean,
because we want the world to know about this technology.
That's good.
We
That's
do,
good.
because again, as a PM, it's the instantaneousness, if I can get that word out, of I can do da 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 da, boom, yep, and now I'm back to my flow. I mean, there's just nothing else.
Yeah.
That does it.
No, so there's stock charts is my main outlet. I am actually also since 6 months now the director of data for stock charts, which is like a side job. So I run basically all the agreements with data vendors and stuff, and then obviously from the RRG point of view, we've got the blog on stock charts for RRG charts. I do Sector Spotlight. That's a weekly show, airs every Monday on YouTube. And then RRG Research has a number of other outlets. Optima is one of our biggest implementations. Optima is what I call my technology partner for other implementations, which you can find on the State Street website in Europe, where you can see some of the State Street ETFs for the European markets. We're on the website of the Hong Kong Economic Journal. We're connected to 2 websites in Vietnam, Indonesia, just started with China. So there's a lot going on there. But right now,
it's a lot since we first met each
exactly,
other. Exactly,
yeah.
great.
And then what I told you in Brazil, the company is called 11 Research. That's part of XP, which is one of the biggest brokers in Brazil. So for the Brazilian market, 11 Research is our licensee there. So yeah, there's a lot going on, but stock charts and after that Optima are the main partners when it comes to implementations, and we work with them when people on websites approach us and say, hey, can we have an RRG on our website? And we find a solution to license that on their website, and depending on how big or how small and what the universe is, find a way to get that going.
Well, I hope all of you watching have benefited from this. If you have questions that are specific, ask Julius. If you'd like to contact me, cb3@cb3.com. Happy to tell you about the 10 plus years I've used RRGs. It's been a great partnership for how I manage money. Julius, thank you for your time. Wishing you the very best over there in Amsterdam. Stay cool in this blistering hot summer. And we'll see you next time you're in the States.
Absolutely.
Take care, my
Yeah.
friend.
Thanks for having me, Charles. Always a pleasure.